So this is about trends and where we've been and where we're going. Today, your group is investing. When you and I talked last night for a minute, you guys are investing differently today than you were yesterday, or 2 years ago, or 3 years ago. Can you talk about the environment that brought us to today, and how you guys were making decisions within your group on your multifamily, and things that were of interest 3 years ago that may be different to today, were different 2 years ago, 1 year ago?
Yeah, sure. That's a great question. And thanks for filling in.
My pleasure.
Yeah. When we started, GSH started in 2017, right? So it's only been around for 5 years. Before that, I was doing high volume single family aggregation for institutional clients, which means basically I was buying a lot of houses and selling them to large institutional groups. And when we started buying in 2017, there were folks who said, "Are you sure you want to get into multifamily? I think we're at the top of the market," right? And that made me feel nervous. But at the same time, I'm really glad I didn't stand on the sidelines, because there was another 5 years of a great run behind us and a lot of wind at our back. We were looking at buying always properties in, we were somewhat location agnostic, but always interested in real estate fundamentals. Where's the property located? How are the schools? How's the walkability? Crime? Who are the replacement tenants? Meaning like if you buy a property and you complete a value add where you're maybe enhancing the amenities and enhancing the units and making it nicer so you can charge more rent and create value to the bottom line. Where are you going to get those replacement tenants? Where are there going to be? Are you located where folks can afford the rents that you pro forma to be able to charge, right? And that hasn't changed, right? That hasn't changed. But
that's kind of blocking and tackling. Right?
Yeah, that's blocking and tackling. But right now we're much more on defense, right? And while call it a year or two ago, let's say 50 to 75% of my organization was focused on acquiring new markets, due diligence of new properties. I would say that probably 30 to 40% of it is focused on that today, and now we're focused on the assets that we've got, especially ones where we got into short-term floating rate debt, and because those interest rates have gone up, that affects our ultimate bottom line. Also, in those deals, you're looking to refinance at some point out of that debt, and long-term interest rates have gone up by 200 basis points in some respects, and that ultimately affect proceeds when you refinance. So, to answer your question, we're really looking at the debt market, the equity market, and getting into opportunities right now that are more growth oriented. And so, growth would be, can we buy something at a discount, mark to market, that in terms of what they were valued a year or two ago, and are they located in areas that we know based on key demographic indicators like jobs and population growth that will obviously continue a trend upward into the future.
How important was sustainability 5 years ago compared to today?
So it was less important, I think. But even 5 years ago in multifamily, there were programs that were being introduced through like the agency lenders, like Fannie Mae had a green initiative where if you purchased a property and used a Fannie Mae loan and committed to creating certain energy efficiencies at the properties, you would get a discount on interest rates that would ultimately enhance your property. So we've been seeing that for a long time. Personally, I think that it's very important, right? Personally, I'm a fan of green initiatives, and I think that it's maybe a little bit more important to equity than it is to sponsors at times. ESG, environmental, social governance, carbon neutral. Like, I think it's good to do well financially while doing your part, to protect the environment. And I definitely see that is a key focus for a lot of family offices and other investment groups. And so I think you're going to see more of that in investment offerings nowadays, because I think the ground is responding to the folks who are writing checks.
So Scott Goodman in the last panel talked with you about Bronzeville and in Chicago, and a huge focus of that project is to get it right, carbon neutral, get it right, make it part of the community, make certain that tomorrow is going to look better than yesterday. And the idea is that's going to attract tenants. That's going to make it such that people will be more comfortable paying the rents that might be at or reasonably priced. Are you seeing that in your practice, Tim?
I mean, if I could do every project that way, I mean, it would be ideal. I mean, I think that's an amazing project. For us, where we're doing some new construction, but often we're buying existing properties. It's about enhancing for us. We're doing green initiatives, but it's more about enhancing the lifestyle of the residents. So we feel that a competitive advantage for us, and in the multifamily industry in general, is focusing on community and the community that we're investing in. So our business model from the beginning has been workforce housing, and servicing the country's essential workers. Now, essential workers is a word that we started using in 2020 because everybody understood what it was, but we call it, our model is affordably priced apartment community. So not affordable, not subsidized, but places where people who have good jobs, your doctors, your nurses, your teachers can live and be proud of a place and call it home.
And the idea is it becomes a partnership almost, right? It becomes a partnership with your tenants and your buyers.
Oh, you would hope, right? You would hope that folks would be proud of where they are and see the value that's been created since we purchased a property and the invested dollars. The partnership would be them, not only paying their rent on time, which is the obvious, but contributing to the community. So, in certain demographic properties, we've got a program where we offer free telehealth and free tutoring to folks, who are probably a little bit more in need of that. In other demographic areas, we've got a proprietary platform that focuses on community. So social gatherings, a marketplace for residents to maybe buy and sell goods to one another, and also socialize and be a part of the community.
Switching gears, what do you see going on in the debt markets, where we were a couple years ago versus where we're going now?
Interest rates are going up, right? Interest rates are going up. I did a communication to my investors a few weeks ago, a month ago. I don't remember exactly, but it was kind of like the way that Gideon sees things at the moment, right? And it had to do with why are the returns that we're seeing today different than the returns that we were seeing a year or two ago. And I touched on it at the end of the last panel, which is, debt was low, and so prices continued to go up, right? Inflation gave people more money in their pockets. People were able to pay more in rent. Prices continued to go up, and debt stayed low, right? And then because of the pandemic and the commercial office space market in terms of investment, less people want to invest in commercial office because there's still a question mark around what that's going to look like. Are companies going to downsize or upsize? Right, exactly. Are they going back? So that money still needed to go somewhere, so it went into multifamily, so more and more competition. And so as prices go up, yields go down. The amount of money you can make in a deal goes down. Now that interest rates have gone up, I do see cap rates coming up, meaning values coming down a bit. But in multifamily, I don't see a huge correction. I think that that prices might come down 10, 15%, and then they're going to start going back up once the Fed says we're done raising interest rates, because again, there's a housing shortage, there's a unit shortage throughout the country, and so investors are just going to have to be okay with tighter yields and maybe be more strategic about investing because of the tax advantages of real estate.
I mean, some projects just won't get done.
I mean, I think that there are a lot of projects that were planned that won't get done, and we're not seeing a lot of projects trade. You know, our inboxes were inundated on a regular basis with new offerings, new multifamily communities being offered for sale, and while we still see that coming through, it's probably 10-20% of the volume that we saw just 6 to 12 months ago. So people aren't selling also. Everyone's waiting kind of for things to normalize.
So what do you see in the Midwest? How do you feel like the Midwest is doing? Are you seeing a lot of projects in the Midwest? Or obviously the Southeast is really hot, or maybe it isn't. What do you see going on here in Illinois, Indiana, Michigan?
Well, we built our portfolio here in our backyard in Michigan. We're in Michigan, Indiana, Ohio, Maryland, Florida. We're kind of agnostic, but we've only been successful in building footprints in those 5 states to date. But a big concentration is in Michigan because we wanted to build a platform in our backyard. And what I see in the Midwest is that while our demographics and population growth is often par, is often just little up, little down every 10 years, but nothing like the Southeast.
No crazy fluctuation.
Yeah. You have strong communities, you have a lot of wealth concentrated, and you have people who pay the rent, and if you can stay in areas and counties and municipalities that are relatively landlord friendly from like an eviction perspective, we've been able to do very well in the Midwest. It's been a slow and steady, and when we got involved in 2017, institutional money didn't want to be in the Midwest. It wasn't sexy enough. And over the last 24 to 36 months, we've seen a lot more competition come our way because you hear secondary and tertiary markets where we live in them here, and that's become more attractive. And you can't argue with the growth in the South, in the Southeast. In Florida, where I have a place, it's something like 1,000 people move there a day. That means those people need places to live, and there's jobs to place them, and same with Texas. And so while it's hard to fathom a price per unit continuing to go higher and higher, and I believe there'll be a ceiling in terms of affordability, in terms of how much somebody can pay every month in rent. I shied away from acquisitions in Florida when I personally moved there in a handful of years ago. I got a place down there. Because it seemed really high, and it's just continued to go higher and higher and higher. So I don't know where the limit is there.
Quickly, debts or equity sources. We're all interested, I guess, in having multiple equity sources in all of our projects. Can you talk about how you guys source equity, where it comes from, and all that?
Yeah, sure. So we've been fortunate enough to not take on institutional equity at this point. So institutional equity being life insurance companies or hedge funds. And part of that was because, we started in Michigan and Michigan wasn't sexy enough for institutional money. And the other part was control. I've never really wanted to have somebody else in a high-rise building in, let's say, New York, determining, if I should sell or if I should refinance. A lot of our income or our benefit of owning this real estate is on the back end, and so we didn't want to have somebody else determine if we're making money or not. So to answer your question, though, we've got a very large investor base. We've got over 800 individual investors, all accredited individuals, small individuals, family offices, that write checks on a deal-by-deal basis to us. And over the last 2 years, we've raised $200 million from those investors for our projects alone. And so we've garnered a really great following. We've been fortunate.
Well, Does anybody have any questions? Is there anything? I'll open it up to them.
Let me speak to like the growth versus opportunity, right? Which was on the card. So Lynn asked me if I do this talk because we have an opportunity fund and a growth fund right now, and up until this point, we've raised our money deal by deal. We get a deal, we put out an offering, it fills up. But right now, because deals we're being more discerning about what we want to buy. I like to still have a calling card. I still like to show someone, what it is that we do. And opportunity is more agnostic. Is there distress? Are we picking up a property at a discount to replacement costs? Do we see value in being able to buy this asset and elevate it and increase the net operating income and increase the value, right? That's opportunity, opportunistic, makes sense, right? Growth is kind of just betting on the demographics I spoke of. So I don't think there'll be many acquisitions in Michigan in the growth fund, right? Because unless we think that we can buy something at a discount and it'll just grow organically, it's more about betting on the 1,000 people moving to Florida every single month or every single day. Excuse me. It's betting on Texas and where there's going to be growth and the numbers are on our side. And getting involved in those hotter markets. And so I think that growth is based on demographic, right? Growth is based on trends. Growth is based on the numbers that don't lie. And opportunity is where you roll up your sleeves, you dig in, and you have to go out and hunt and find that opportunity. And as I mentioned, there's going to be opportunity in this the cycle of the economy because interest rates are going up. Because people are feeling pain because interest rates are going up, because values are going down, because people got into, or sponsors got into short-term fixed or floating rate debt, right? And they're not going to be able to refinance into long-term debt like their plan was. And they're going to have to sell at a discount. And if we can pair our ready equity up with those pain points at the right time, I think there's going to be a lot of opportunity. One other piece of opportunity that we see is a vehicle for filling the gap, kind of call it sponsor rescue capital. So for those folks who are at the end of their term of short-term debt and they need to refinance, let's say that I got a mortgage for, or someone got a mortgage for $50 million in a short-term loan. And their plan was to increase the value of the property and refinance 2 years down the road and get a new loan for $60 million, right? And take the 10 extra, pay off the $50 million, take that 10 extra and give it back to their investors, right? That was a common value add strategy, right? Well, now, because interest rates at the time when they took out the first loan were 3.5, and they modeled to 4.5, and now they're at 6, they might only be able to borrow $40 million, right? They might be $10 million in the hole. So if someone can go in like a preferred equity position, if we can go in and we can fill that gap so they can see the project through with nice economics and a preferred position to the original equity and take a piece of that sponsors promote, there's a real opportunity there. And my firm is really bullish and active on that program at the moment.
Thank you very much.
Thank you.